October 1929. The stock market didn't just crash, it vaporized $13 billion in a single day. And the part they don't teach you? It was completely avoidable, and it gets way worse. Imagine waking up a millionaire on a Tuesday, and by Thursday, you're broke, your bank is gone, and your neighbor just sold his car for bread money. That's not fiction. That's October 1929. The roaring 20s had turned into the screaming 30s, and even the economists were panicking, which is rare because they're usually just confused. Picture this. Men in expensive suits standing on street corners selling apples for a nickel. Families living in cardboard shacks they called Hootervilles. Bread lines stretching for blocks. And this wasn't some third world country. This was America, the richest nation on earth. So what the hell happened? How did the party of the century turn into the worst economic disaster in modern history? Here's what they tell you in school. The stock market crashed because of speculation and panic selling. Cool, simple, clean. Except that's only half the story, the sanitized version they want you to remember, because what they don't tell you is that the entire system was rigged like a casino where the house was also gambling with your money. Let me paint you a picture of the 1920s. America was booming. World War I was over. New technologies were exploding. Cars, radios, refrigerators, electricity spreading to every home. Companies were making money hand over fist. And Wall Street? Wall Street was the hottest ticket in town. Everyone, and I mean everyone, was buying stocks. Your doctor, your teacher, your cleaning lady, even shoeshine boys were giving stock tips. The Dow Jones Industrials went from 63 points in 1921 to 381 points in 1929. That's a 500% increase in 8 years. People thought they'd discovered a money printing machine. Get rich quick wasn't a scheme, it was the plan. But there was a problem, a massive economy-destroying problem that nobody wanted to talk about, because here's the part they conveniently skip over in every history class. In the 1920s, you could buy stocks with only 10% down. Let that sink in. You could control $1,000 worth of stock with just $100 cash. The rest, borrowed money. Banks were lending to everyone, your barber, your taxi driver, your grandmother, so they could gamble on Wall Street. It's called buying on margin, and it's basically the economic equivalent of betting your rent money on a horse race using a loan shark's cash. This wasn't investing. This was a Ponzi scheme wearing a three-piece suit. And here's the kicker. The banks lending the money, they were also buying stocks on margin with their depositors' money. Think about that. Your life savings sitting in a bank account was being used by that bank to gamble on stocks without your permission, without your knowledge. It's like watching someone juggle knives standing on a tightrope over a pit of fire, yelling, "Trust me, I've got this." By 1929, margin debt had reached $8.5 billion. That's roughly $130 billion in today's money. All borrowed, all leveraged, all built on the assumption that stocks would never go down. But it gets worse. Investment trusts, basically the hedge funds of the 1920s, were buying stocks with borrowed money, then selling shares of themselves to regular people who bought those shares with borrowed money. It was leverage on top of leverage on top of leverage, a house of cards built on quicksand during an earthquake. And the regulators, the people supposed to protect against this insanity, they did nothing. There was no SEC, no federal oversight, no rules against insider trading, no margin requirements. Wall Street was the Wild West, and the sheriffs had all quit to become bank robbers. But the craziest part? People saw this coming. Experts warned about it, and they did it anyway. Throughout 1929, warning signs were everywhere. Economic production was slowing down. Car sales were dropping. Construction was declining. Regular people were already struggling with debt, but stock prices still climbing. Why? Because reality doesn't matter when everyone's making money. In March 1929, the market had a mini crash. Stocks dropped 10% in one day. People panicked for about a week. Then they went right back to buying. Economists like Roger Babson warned that a crash was coming. He was laughed at, mocked, publicly ridiculed. Smart investors like Joseph Kennedy, JFK's father, started quietly selling their positions and getting out.
Even the Federal Reserve raised interest rates multiple times to cool down the speculation. Nobody listened. Greed is a hell of a drug. By September 1929, the market hit its peak. Stocks were trading at 32 times earnings, absolutely insane valuations that made no economic sense. Professional investors knew this couldn't last, but amateur investors kept pouring in, convinced they'd found the secret to eternal wealth. Then came October 24th, 1929, Black Thursday. The market opened and immediately started falling, fast, hard, violently. Panic swept through Wall Street like wildfire. 12.9 million shares traded in a single day, a record that absolutely terrified everyone. People were screaming, fainting, crying on the trading floor. A group of powerful bankers, including the heads of Chase, JP Morgan, and others, pooled their money and started buying stocks to stop the bleeding. It worked. The market stabilized. People breathed a sigh of relief. "See," they said, "everything's fine. The crash is over." They were dead wrong. The next few days were rocky, but the market held. People convinced themselves the worst was behind them. October 29th, 1929, Black Tuesday. The dam broke. 16 million shares dumped onto the market in pure panic selling. The trading floor looked like a war zone. Grown men were weeping. Fortunes evaporated in minutes. The ticker tape, the technology that showed stock prices, couldn't keep up. It ran hours behind, meaning people were selling stocks without even knowing what price they'd get. Chaos, pure financial chaos. By the end of the day, the market had lost 12% of its value in a single day, but that was just the beginning. Over the next 3 years, the market would lose 89% of its value. 89%. If you had $10,000 in 1929, by 1932, you had $1,100. And that's if you were lucky enough to still have access to your money. Because here's what happened next. The banks started failing. Remember all that margin lending? All those bets the banks made with depositors' money? Yeah, those bets were now worthless. Within 3 years, 9,000 banks failed. That's not a typo. 9,000. People lined up for hours to withdraw their savings, only to find the bank was closed permanently. Their money just gone. No FDIC insurance, no bailouts, no safety net. You lost everything, and there was no one coming to save you. Millionaires became homeless overnight. Investors jumped out of windows. The suicide rate spiked so dramatically that trading floors had to install barriers. Families lost their homes, their farms, their businesses. Everything they'd worked for their entire lives gone in a matter of weeks. And here's the brutal part that should make you angry. Some experts argue this wasn't even a crash. It was a robbery wearing a crisis costume. The insiders, the bankers, the corporate executives, the connected elite, they saw it coming. They cashed out early. They protected themselves. It was the average person, the school teachers and shopkeepers and factory workers who believed the hype, who held on to the bitter end. They held the bag. They paid the price. They suffered for decades. This is the moment the machine broke. Banks froze. Credit vanished. Businesses collapsed overnight like dominoes. Factories shut down. Farms foreclosed. Unemployment skyrocketed. By 1933, 1 in 4 Americans was unemployed. 25%. The official number was 15 million people, but it was probably higher because they stopped counting after a while. Industrial production fell by 47%. Construction basically stopped completely. International trade collapsed by 65%. If money could scream, this is the moment it would have lost its voice. The Roaring '20s didn't end with a whimper. It ended with financial Armageddon. In the Great Depression that followed, it lasted for 10 years, an entire decade of suffering, poverty, and desperation, all because of 1 month in 1929. But here's what they really don't want you to know, the part that affects your life right now. The 1929 crash didn't just cause the Great Depression, it rewrote how money works forever, and those changes are still controlling your financial life today, almost a century later. After the crash, the government had to do something. The entire economic system had imploded, and people were furious. Revolution was a real possibility, so they created new agencies and new rules. The SEC, the Securities and Exchange Commission, to regulate Wall Street and prevent fraud.
The FDIC, the Federal Insurance Deposit Corporation, to insure bank deposits so you don't lose everything if your bank fails. Laws against insider trading, making it illegal for corporate executives to profit off information regular investors don't have. Margin requirements, limiting how much you can borrow to buy stocks so you can't leverage yourself into oblivion. Glass-Steagall Act, separating commercial banks from investment banks so your savings account can't be gambled away. These reforms worked. For decades, they worked. The financial system stabilized. The middle class grew. Banking became boring and safe. Sounds good, right? Here's the problem. We keep forgetting these lessons. In the 1980s and 90s, Wall Street started pushing for deregulation. Let the free market work, they said. Government regulations are killing innovation, they claimed. And slowly, piece by piece, those protections got stripped away. Glass-Steagall repealed in 1999. Margin requirements loosened. Oversight defunded. And what happened? 2008. Banks gambling with mortgages. Leverage ratios hitting 30 to 1. Derivatives so complex that even the bankers didn't understand them. The housing market crashed. Banks failed. The economy collapsed. Same energy, different decade, different buzzwords, same greed. We bailed out the banks with taxpayer money, slapped on some weak regulations, and within 10 years, Wall Street was right back to its old tricks. And it's not just Wall Street. Crypto crashes, people buying digital assets they don't understand with borrowed money, sound familiar? Meme stocks, retail investors gambling on hype and momentum. Ring any bells? SPACs, margin trading on Robinhood, leveraged ETFs. The game changes. The greed never does. And that margin buying that destroyed 1929, it still exists today, just with fancier names like leverage and derivatives and synthetic positions. Your 401k, your retirement, your financial security, they're all built on a system that's crashed multiple times because people thought this time is different. The dot-com bubble, the housing crisis, the COVID market volatility, every single time, the pattern is the same. Easy money leads to speculation. Speculation leads to leverage. Leverage leads to bubbles. Bubbles always pop, and every single time, regular people get hurt the most, while the insiders walk away clean. Spoiler alert, it never is. History doesn't repeat, but it sure as hell rhymes. So what does 1929 actually teach us? Finance isn't math, it's psychology in a suit. Every crash in history follows the same psychological pattern. Phase 1, displacement. Something new comes along. New technology, new market, new opportunity. The 1920s had cars and radios. The 2000s had the internet. The 2020s have crypto and AI. Phase 2, boom. Early investors make money. The media covers it. Everyone starts paying attention. FOMO kicks in. Your neighbor's getting rich. Why aren't you? Phase 3, euphoria. This is when rational thinking dies. People quit their jobs to day trade. Taxi drivers give stock tips. Everyone's convinced they've found the secret to infinite wealth. Risk? What risk? Phase 4, profit taking. The smart money starts quietly exiting. Insiders cash out. Professional investors reduce positions, but they do it slowly so they don't spook the herd. Phase 5, panic. Something breaks. A margin call, a default, a scandal. Suddenly everyone realizes the emperor has no clothes. The rush for the exits begins. Phase 6, capitulation, total collapse. Assets sell for pennies on the dollar. People lose everything. The psychological damage lasts for a generation. And Phase 7, amnesia. This is the scariest part. Give it enough time, and people forget. A new generation comes along that didn't live through the crash. They hear stories of easy money. They think, that could never happen to us. We're smarter. We have better technology. We have regulations. And the cycle starts all over again. We act like the stock market is this logical, rational system guided by fundamentals and data. It's not. It's millions of humans making emotional decisions with life-changing consequences, driven by fear and greed, hype and panic.
The crash of 1929 didn't happen because of bad luck or because of some unpredictable black swan event. It happened because people chose short-term gains over long-term survival. They chose greed over caution. They ignored the warnings because acknowledging them would have meant admitting the party was over. And if you think that sounds familiar, if you look at today's economy and see echoes of 1929, well, you're paying attention. The question is, are we paying attention enough to do something about it? Or are we going to learn this lesson the hard way all over again? The crash of 1929 destroyed the economy, but what came after, the political response, the international consequences, the rise of extremism, that's what almost destroyed the world. Because when people lose everything, when they're hungry and desperate and angry, they start listening to very dangerous voices. And those voices in the 1930s led directly to World War II. That's a story for next time. If you want to understand how money really works, instead of just watching your portfolio go red, hit subscribe because the next crash is coming. It always is. The only question is whether you'll see it coming.